All right, today let's talk about why mortgage rates stay high even when inflation is easing. And this is happening right now in the real estate market. If you're new to economics or real estate, it can feel extremely confusing to hear that inflation is easing while mortgage rates remain high, especially for people that want to refinance. Many people assume that lower inflation should immediately lead to lower mortgage rates. In reality, the connection is not direct. This video, what I want to do is explain really in simple terms why mortgage rates can stay elevated even as inflation cools. Let's do this. First, let's talk about what inflation actually is. Sorry, I'm getting ahead of myself. Inflation measures how fast prices are rising across the economy. When inflation slows down, it means prices are still rising, just not as quickly as before. It does not mean prices are falling though. Let's talk about how or what mortgage rates are tied to. Mortgage rates are not set directly by inflation or by central banks. They are heavily influenced by long-term bond markets, especially government bonds, and especially the 10-year bond. Investors who buy these bonds care about long-term risks, not just current inflation. Here's the big key difference. Inflation data reflects what has already happened. Bond markets focus on what might happen next. You see, if investors believe inflation could return or that economic risks remain high, they demand higher yields to protect themselves. Those higher yields translate into higher mortgage rates. Another important factor is supply and demand. When governments issue large amounts of debt, investors must be compensated to buy it or they're not going to want it. Higher supply of bonds can push yields up. Mortgage rates move in the same direction because they compete with bonds for investors' money. So now we got to look at central bank policy. Even when inflation slows, central banks may keep policy rates elevated to ensure inflation is fully under control. They want to avoid cost cutting or cutting rates too soon, to reignite price pressures. If they cut too soon and people dive in and speculate, it drives prices higher. Expectations matter more than headlines. Now, what about risk premiums? You got to talk about that. Mortgage loans carry risk. Lenders price that risk into rates. What's the risk? You may not, or somebody they give money to may not pay their mortgage someday if the economy gets rough. During uncertain economic periods, lenders demand higher compensation for long-term loans. This keeps mortgage rates elevated even if inflation data looks better. There's also another issue. That's housing market dynamics. If housing supply is tight, prices remain high. High prices combined with elevated rates make affordability worse. It's where we are right now, right? Lower rates alone do not fix this imbalance, so lenders remain very cautious. Now remember, mortgage rates, and this is a big misunderstanding with beginners, they do not move one for one with inflation. They move based on expectations, bond markets, and risk perceptions. This is why rates can stay high or even rise when inflation appears to be improving, like we're seeing now. And here's a big takeaway you need to look at. Mortgage rates are forward-looking. They reflect what lenders and investors believe the future will look like, not just what recent data shows. And this is why patience matters. Waiting for inflation to cool does not guarantee lower mortgage rates at once. Other forces must align, including stable expectations, reduced uncertainty, and balanced supply and demand. Understanding this relationship helps explain why headlines and personal experiences often do not match. It also helps buyers and investors plan realistically instead of relying on assumptions. And once you understand how mortgage rates are set, you can focus on what you can control. Budgeting, timing, and deal structure, they matter more than waiting on perfect conditions. And that understanding is what turns frustration into strategy. Look, if you want to learn more about mortgages, how to get better rates, all these different types of mortgages that really aren't covered in the mainstream, and how to save tons of money, not only in the rate, but in the cost of getting the mortgage or refinancing that mortgage, I'll throw a link to the Mortgage Master course down below. I'll make it a sale link. So you can check this out, learn, and then save boatloads of money the next time you take out a mortgage or refinance yours. Hopefully you got something out of this. Thank you so much for watching. I'm out.